Imagine being able to know what the stock market will do next. You would be able to buy stock before it goes up and sell it right before it comes down. In the book Mastering the Market Cycle by Howard Marks, we learn how we can identify the ups and downs of the market, why they happen, and how to profit from them. First, it's important to understand the market patterns. Imagine being in a game show. If you play the game right, you can make some good money, but if you don't, you lose money. So, let's play this game. There will be 3 bags in front of you, each one containing a combination of white and black marbles in it. You have to pick one bag, and you have to draw one marble from the bag you chose. If you get a black marble, you win $10,000. But if you get a white marble, you lose $10,000. These are the bags you can choose from. Which of these bags would you choose? Write your answer in the comments and see what other people said. Got your answer? If you chose bag number 1, you have an 80% chance of winning and only a 20% chance of losing. Bag number 2 has a 60% chance of winning, and bag number 3 only has a 30% chance of winning. It is important to note that even with bag number 1, you are not guaranteed to win. You can still pull a white marble, but you have a much higher chance of winning than you do losing. But let's say that you picked bag number 1 and you drew a black marble, which means you won $10,000. Now it's time to move on to the next round. In this next round, you have a second set of options. In this new round, you can choose to skip it and hold your $10,000, or you can play for a chance of another $10,000. What would you do? Would you play? Or would you skip? If you chose to skip your turn, you made a great choice. In this new round, neither of the bags give you a good chance of winning, and by playing, you are at a much higher risk of losing your money. Understanding market cycles is quite similar. There are times where many companies are more likely to go up in value, and there are times that even good companies are likely to lose value. When the market looks like the first set, investors can put more money on the table since there's a higher chance that they will win. But when the market looks like the second set, the investor might want to take some money off the table until the odds go back in their favor. You see, markets are cyclical. They rally, then they crash. Then they rally again, then they crash again. So to profit from these cycles, we must be able to understand them. There are 2 components that make up the market cycle: market behavior and productivity. Market behavior is the combination of the collective psychology of investors, the economic environment, like inflation, interest rates, and company profits. Like we described in our Intelligent Investor video, the market behavior is like a pendulum, and it moves from optimism when prices go up to pessimism when market prices go down. This market behavior moves around the productivity growth line, which is the actual productivity that businesses have over time. This productivity growth line represents the actual value of financial assets. Supporting those 2 together, we get an economy cycle that looks like this. A recovery of asset prices from a market crash towards the midpoint. B, a continued swing past the midpoint to an extreme high. C, the attainment of the extreme high. D, the correction of the extreme high towards the midpoint. E, the continuation past the midpoint towards a new extreme low. F, the reaching of the new low. G, once again the recovery from a low towards the midpoint. What is interesting is that these events don't just follow one another, they cause each other. When the market is in a rally, everyone is excited because they are making money, so asset prices begin to go up. Then they go up so much that they go past the actual value of the company. Eventually, investors see that company profits cannot justify the price of the stock, so they start to sell, which causes a downtrend in stock price. Since everyone is losing money now, the market becomes pessimistic, and prices continue to drop even past the actual value of the company. When prices reach a new low, many investors realize that the price of the stock is actually not bad, especially compared to the company's profits, so investors begin buying the stock more. This creates an uptrend in stock price, creating optimism in the market because everyone is making money again. So when the cycle is at its peak, your positions might look like this, and when the market cycle is at its low, your options might look like this. By understanding where we are in the cycle, we can modify our strategy to protect our money when the odds are against us, or help it grow when the odds are in our favor. Now, it is important to note that market cycles are not as beautiful and clean as they are illustrated here. There are a lot of nuances and influences that dictate market behavior, and no one can actually know when the peak of the market is and when will it correct. But, as Mark Twain once said, history doesn't repeat itself, but it does rhyme. We cannot expect a crash to be just like the last one, but we can learn from the patterns. There are two main patterns that we must know in order to understand cycles: the long-term economic cycle and the short-term economic cycle. But before we go over the cycles, let's give a huge thank you to this video sponsor, Southern New Hampshire University, which can prepare you for a high-paying career. With the largest accredited and non-profit online degrees in the country, SNHU features over 200 degree programs focused on getting you started in a career that you'll love. A program that I think would be very useful for you guys is SNHU's financial degree. This program prepares you for a variety of roles, such as financial analyst, professional banker, risk analyst, or financial consultant. And the best part is that all of SNHU's programs are extremely flexible. There are no set time classes, which allows you to work at your own time from anywhere. And if you already have college credits, you don't have to start over. SNHU will let you transfer up to 90 credits towards your bachelor's degree and up to 12 credits towards your master's. So go to snhu.edu/bettermen to see the average salary for these careers and request free information about the program. And a big thanks to Southern New Hampshire University for sponsoring this video. Now back to the video. The long-term cycle has to do with productivity growth. If we zoom out, we can see that the productivity growth line also has cycles. This long-term cycle is measured by what is called the GDP, or Gross Domestic Product, and it measures the actual amount of goods and services produced in the country. This metric is mostly represented by two things: how many hours have been worked and how much we are able to produce per hour. This is one of the reasons why the GDP in the US declined in the previous years. A combination of unemployment as a result of the pandemic, the Great Resignation, and supply chain issues made the country work less hours and produce less per hour. Now, there are other things that affect the long-term cycle, like automation, which can help businesses increase their productivity per hour. Public sentiment also has an impact. There are many times within history where workers were dissatisfied with their conditions, which led to a decline in productivity. Immigration also has an impact on the overall GDP. Immigration tends to create an increase in available workforce ready to produce, helping the GDP. A good economy has around a 2% average return in productivity, or GDP, per year. Now, the short-term cycle is a lot more sensitive to outside influences. Emotion plays a big part in short-term economic fluctuations. People can choose to consume more because headlines are favorable, or the opposite. People can choose to consume more when headlines are not favorable, or when credit is more available and cheaper, or just because their team won the World Series. Emotion is one of the reasons why it's so hard to predict a short-term market cycle, but there are many other influences that might give us great information on where we stand. Like the government anti-cycle. The government is an important part of managing economic cycles. Inflation is an important part of understanding cycles. Too much strength in the economy creates high levels of inflation, which eventually leads to a recession. Too much weakness in the economy can crash company profits, which leads to unemployment, causing a recession. The central bank needs to keep economic cycles in check. If the economy is overheating and inflation is going up too much, they must cool the economy down by reducing the money supply in the economy. So the Fed increases interest rates or sells financial assets to take money out of the economy. The opposite is also true. If the economy is underperforming, the central bank increases the money supply by lowering interest rates, buying financial assets, and creating stimulus programs. Understanding where inflation is can give a good indication of what the government will do next to either accelerate the economy or cool down the economy. How much profit a company is making is also a good indicator of the health of the economy. If companies are reporting strong numbers and growth in profits, we have a good indication of a strong productivity growth. Debt is also an important part of the short-term economic cycle. Companies use debt to finance their growth or buy long-term assets, like office buildings, warehouses, or machinery. Debt is also used by companies to refinance their old debt. Something that many people don't know is that many companies don't actually pay off their debt. They simply refinance and extend their debt. The problem happens when a company is unable to issue new debt when it's time to pay off the old debt. When this happens, they either have to lower their profits to pay off their debts, which affects the profit cycle, or default on their debt and be forced into bankruptcy. The credit market also has a major impact on people's psychology. When credit dries up, people become more cautious, which creates downward pressure in the economy. The debt cycle goes like this. Prosperity brings extended lending, which leads to unwise lending, which produces large losses. This makes lenders stop lending, which ends prosperity, and on and on and on. Notice how these cycles influence each other. The debt cycle influences the profit cycle, and the profit cycle influences the psychology cycle, and the psychology cycle influences the consumption, and the consumption influences whether the economy underperforms, which influences whether the government steps in or not. So now that we understand the different factors that influence the short-term cycle, how do we test the market to see where we are in the market cycle? Your job as an investor is to look at asset prices and the psychology of the market to assess where they stand in the cycle. This means to refuse to buy and perhaps to sell when valuations and psychology are too high, and to buy when the psychology and valuations are getting low. A good investment isn't just about finding high-quality assets, but finding those high-quality assets at good prices. It is not what you buy that determines your results, but how much you pay for it. There are two main things to look at to assess where we are in the market: the fundamentals and the psychology. Here's a quick chart from the book to assess how the fundamentals of the economy are doing. These are the more practical things that are fairly easy to assess, like the interest rates or recent market performance. The more difficult question is, how are investors feeling? How is the psychology in the economy? Are asset owners willing to hold or eager to sell? Are they taking too many risks, or are they too risk averse? Once these questions are answered, we'll have a better understanding of where we are in the cycle, what is likely to come, and how to prepare for it. This book is so packed with information that if I touched on every detail in this video will be like 2 hours long. So I highly recommend to read. It's super fascinating to learn the little details that affect our economy and therefore our personal finances. Let me know your thoughts on this book, and I will see you in the next video.